It's Tuesday, and that means we're getting technical, and it is Technical Tuesdays. Our guest for the week's installment of Technical Tuesday is J.C. Peretz. He's president of Eagle Bay Capital and editor of the technical analysis blog allstarcharts.com. He joins us from New York. JC, let's begin this morning. We're going to take a look first at the S&P 500. And you say I would rather be in Canada. Does that mean the U.S. is running out of steam, or we're gaining some up here?
I think that it's really just the momentum shifting to Canada relative to the United States. I think it's an area where we could start to see outperformance out of Canada for really the first time in several years. And there's a lot of reasons for that. First of all, if you recall, if you look at the ratio of the S&P 500 relative to the TSX, we had a pretty monstrous breakout back in 2005 that's really lasted the last lasted about 3-4 years and then rolled over, and we're back down to that level. So the market has memory here, not to mention that momentum has definitely started to shift in favor of Canada. So if we start breaking this 7.8, 7.9 level on that particular ratio, I think that's really confirmation that Canada should start to outperform. And not only that, if you look at the way that cyclically, the resources and energy and material space tend to be the leaders towards the end of economic and business cycles. So I could totally see Canada outperforming towards the end of this equity cycle simply for the fact that they have so much exposure in that resource area, right?
That is true. JC, when we look at that chart, we tried to do it a couple of times. That's a relative chart, TSX relative to the S&P 500. We got to that line a couple of times and then gave up. So what makes it different this time? Is it just, ultimately you beat through resistance enough times, you break out of it?
See, you've been talking to a lot of technicians, haven't you, Francis? Yeah, that's exactly right. The more times a level is tested, the higher the likelihood that it breaks. There's no doubt about it. But momentum, relative strength index, which we look at as momentum, has really started to put in a bullish divergence. And there's a lot of reasons why Canada can start to outperform. On an absolute basis, look at TSX. That as long as we're above 12,900, you can really stay long the TSX, and we're looking at a target of about 14,300, which takes us back to the 2011 highs. I wouldn't be surprised if we hit that.
I want to turn back to the S&P 500 again, because we were speaking to a strategist earlier this morning, and he was talking about really there's just blue sky above the 500. Now, you've drawn in some lines here. We've actually broken up against that trend line or above that trend line on the top. What does it mean when you got nothing, no resistance? I mean, do you just calculate a target, or what do you think is going to happen to the 500?
Right, so we're in uncharted territory, right? So there isn't any support and resistance that we can look at, and us as technicians, that just makes our lives more difficult. So we have some Fibonacci extension levels that we take a look at, as well as some trend lines that we like to draw where we're connecting the highs, the peaks, if you will. So going back to the May highs, if you connect all those peaks into August and September, it takes us pretty much where we are right now. So we're actually shorting the S&P 500 and fading these highs, obviously using strict risk management in order to protect ourselves, because at the end of the day, it's not about being right, it's about making money. And if you're not protecting yourself, you could be in a lot of trouble. So especially shorting something this strong. But I think we're better sellers right here, right now, than we are buyers in the stock market, in the U.S. stock market. And in particular, I'm very disappointed with the behavior in biotechnology. So that's one of the areas that we're pressing our shorts on.
Let's talk about the bond market. The bond market's rallying here. Yields are down 8 basis points and prices are up. You have a chart that you prepared. That's the 10-year. You've got a chart of the 30-year Treasury bond. Give us some sense of what this is telling you in the broader picture.
Right. So, I mean, it doesn't matter whether you're looking at the TLTs, which is the ETF, or the 10-year or the 30-year. I use the 30-year because it really moves the most. It's the most volatile. So, it's just a good representative. But they all look pretty much the same. And, Francis, I was on your show back in September, and we were talking about all of the pessimism that we saw out there in the bond market, and just really the consensus by financial advisors and traditional media, social media, and just having conversations with friends, both market participants and otherwise. and it was consensus that you sell bonds. You know, you wake up in the morning, you brush your teeth, and you sell bonds. I mean, that was the environment that we that was the environment that we were in. And when I see that, and it's not just anecdotal, but you look at the actual commitment of traders reports and, you know, all of the sentiment polls and Consensus Inc. and whatnot, and we were at the most pessimistic levels in Treasury bonds since the spring of 2011, just before we saw a 50% rally in the U.S. Treasury bond ETF TLT. And I'm not saying that we're going up 50%, but to be selling bonds down there I thought was just silly. Obviously, we've been buying the whole way. We're happy, and I think rates are going to continue to head lower, probably looking at about 2.25 on the 10-year.
JC, how does that play into the U.S. dollar? Because we have a sentiment chart that you've prepared that says, as everybody hated bonds in September, they hate this currency, your dollar, right here.
That's exactly right. We're actually seeing very similar sentiment data coming out of the United States dollar that we saw in treasuries a couple of months ago, both in August and September when I was on the show. So I think we could see something also very similar. And let's not forget that the euro USD, the euro is a huge component of the United States dollar index. And as we speak, Francis, the euro is running into those February 1st highs just above 137. So when you have the by far and away the largest component of the U.S. dollar index running into where it rolled over hard at the beginning of February, that was Super Bowl weekend, if you recall, and you have that much pessimism in the U.S. dollar, the unwind of that trade could be vicious. I'm a buyer of dollars down here for sure.
And you mentioned biotech, you're not a buyer of biotech, but I have to ask you before we let you go, because you have not been a buyer of this commodity, you've been absolutely bang on, it's been a mess, and that's coffee. I want to take a look at it with you before we let you go, because somewhere in here, coffee's got to be a big, huge trade. It's not there yet, I'm guessing.
What a disaster this has been, Francis. Oh, my goodness.
Oh,
I mean,
it's terrible.
Lower lows, a disaster.
It needs
lower lows, lower highs.
It needs caffeine.
And like you said, I think that we have the potential. I think we certainly have the potential eventually for a monster run. But there's an old saying that bottom fishing can be very hazardous to your wealth. And if anybody who's tried to pick a bottom in coffee for the last couple of years has just gotten destroyed.